All right. Well, good morning, everybody. My name is Stuart Gordon, and I am the chair of the residential subcommittee of the real property law section. Today is January 13th, and normally we would be meeting in person for the annual residential seminar. Last year, we had to shift the seminar to a Zoom style event. And I was really hoping that this year we could return to be meeting in person again. But due to COVID, we're back here in the Zoom webinar. But the good news is that we have some benefits with this style, such as this year, we're able to make things a little more convenient for everybody. We're having 3 2-hour sessions spread over a couple of weeks. So there's today, obviously. There's also February 3rd and February 17th. You can watch just today. You can watch 2 sessions. You can attend all 3, whatever you'd like. Also, we're able to bring in some speakers who may not have been able to travel to Atlanta to meet in person. So a little variety to that as well. I do hope, though, that next year we'll be able to meet in person and return back to the way that was. Before we get started, a couple of just some items to mention about the seminar. So first of all, you should have received via email just a few moments ago the materials that will be reviewed today. If you have questions throughout the presentations, just post that in the Q&A box at the bottom of your screen. This session is being recorded, and as in last year, it was posted on the Real Property Law section website. I'll check and make sure that can happen again this year. But just keep in mind that as you tell other people, watching the replay does not qualify for credit hours. But fortunately, watching it live here today does qualify for the 2 hours of CLE credit. So with that having been said, let's go to introduce our first presenter. And when we go back and try to figure out a session for each year, try and do some diverse topics, diverse speakers, look through prior years' sessions to see what topics came up, and just try and come up with some different ideas. And as closing attorneys, we know title, the closing, the documents, and the money comes in, the money goes out. We don't always know what happens with the money behind the scene. At least I don't know what happens with the money behind the scene. So I thought it'd be good to get some help and some information about that. Jack Keeler is someone who I met a number of years ago through Mortgage Banker Association. And he has given this presentation to other places, and it's been very well received. Lucky he was able to adjust a little bit, tweak it for us, and I think it'll be a good session. Just a little quick bio about Jack before he goes into it. So Jack Keeler is Assistant Vice President of Sales for Flagstar Bank and has been with them for the past 13 years. Since starting in the mortgage business in 1990, Jack has been a processor, manager, owned his own brokerage firm, underwritten, and spent many years in sales in the wholesale mortgage lending industry. Jack formerly served as the president of the Atlanta Mortgage Bankers Association and served on the board for the Mortgage Bankers Association of Georgia. Jack earned his certified mortgage banker and accredited mortgage professional designations through the National MBA, as well as certified mortgage advisor designation. Jack's passion is helping others understand how the secondary mortgage industry works and where the money comes from and goes to. So with that, I will turn it over to Jack Keeler, and you're take it away.
All right, thank you, Stuart. That is awesome. Good to see everybody. Actually, I can't see anybody, so I'm going to enjoy for the next about 35 to 40 minutes. I am going to take you on a tour. Now, what exactly does that mean? Let me pull up my share screen. See, first technological taboo. Let me go find I erased my presentation. Forgive me. And slideshow from me. Okay, as you see, it says the Tour de Mortgage Finance. So what exactly is the Tour de Mortgage Finance? I have this passion in life. I've been an account rep and everything else for 30 years in the mortgage business. Started when I was 21 years old. but I was always had a passion to do something else. I always had this dream of something I wanted to do. And what I really, really wanted to be was a tour guide. I literally cannot, even when I retire possibly, I want to go somewhere, maybe even where I live, and I want to get on a bus and I want to get a microphone and I just want to yap to people about what they're seeing, what they're experiencing, what they're going through. It may not make a huge difference in their life, but it is going to enlighten them. And it's going to educate them on the location that they're at or the history and stuff like that. So the Tour de Mortgage Finance just basically came because I thought it sounded cool. Tour de, what is it? Tour de France and Tour de stuff. So it's Tour de Mortgage Finance. So what we're going to do is we're going to go through on a tour of the secondary mortgage system, how processes work, where the money comes from, where it goes. You see, I got infatuated with how does all of these people get paid? As an example, in order, every single one of these right here plays a part in the mortgage business. And I started looking at it and I go, okay, we got Fannie Mae, we got Freddie Mac, Ginnie Mae, investors, we got the issuers, we got mortgage-backed securities, we got lenders, we got the banks, we got the originators, we got the processors. How in the world does everybody get paid through that one single mortgage transaction? We even have closing attorneys who have to get paid. And so I started really educating myself on how money works and where it goes and what happens to it. And I found out that every single one of these people, and forgive me here, I'm blocking part of the screen with my stuff over here. Every one of these agencies plays a part in what our mortgage rates are. Also plays in part with how the Fed, I mean, the amount of times Fed has been in the news lately, which I'm going to talk probably quite a bit about today, is astronomical, and how they impact. How does the president impact our mortgage rates and all kinds of stuff? And by the way, at the bottom of your screen, you're going to see a Q&A. Now, I am very notorious as a tour guide of loving to go down back roads. So if you have a question about anything I happen to be talking about, I literally have these screenshots, but I'm going to go wherever the tour takes me. So if you have a question, just click on Q&A. Your chat function does not work. Click on QA and just ask a question there. Hopefully I'll see it pop up. So that's what we're going to do today. You may know Flagstar Bank. You probably have closed many loans with our name on it. You may also know Lisa Lacey. She is my counterpart for Flagstar Bank. So I just appreciate you guys showing up, and it truly is a privilege to get to go over this stuff with you. So the first thing I want to go over, and actually Stuart said, had asked me to do this, is typically not in my stack of slides that I do, because I'm typically presenting to originators or mortgage companies. But he said exactly how the broker, non-delegated, and delegated systems work. I don't want to go into details as far as all the ins and outs of them, but one thing I do want to come across is you deal with a lot of brokers. You deal with a lot of non-delegated correspondents. And the difference between a non-delegated correspondent and a broker is brokers, we as lenders, Flagstar Bank, other lenders, fund the loan. We underwrite it, we fund it. They just originate it. Non-delegated correspondents, we underwrite it. They fund it with either a warehouse line, or if they're a bank, through their own bank funds. And then you got delegated, where they underwrite it and they fund it. And then you got bulk, where they underwrite it, they fund it, they put it together in a spreadsheet. They send us a spreadsheet and we tell them what we'll pay them for each one. So it's a very, that's for your bigger volume lenders. But there's been a big push for brokers lately. So the question a lot of people ask, is it better to be a broker? Is it better to be delegated or bulk or non-delegated? And the answer to that question is, over the last 6 years since the CFPB came out in 2015, is there's been a huge push in the broker market. And you got to ask yourself, why is there a huge push in the broker market? Well, what happened in 2015, 16, and 17, as you all well know, compliance became insanely expensive. The issue is we're having to buy software. We're having to buy programs. And these bigger correspondent lenders that underwrite their own loans, and let's just say, for an example, Movement Mortgage. Most people have heard of Movement Mortgage. It's not an advertisement for them. I'm not pro, against anything to do with Movement Mortgage. They're just a huge mortgage company that most people have heard of. So what would happen is they would recruit, because when you go from broker, your price is this. Non-delegated correspondent, your price gets a little bit better. Delegated correspondent, it gets about 50 basis points better typically. And delegated bulk is quite a bit more. But as that pricing gets better, you would think they can offer better rates to the street. So does the broker have a disadvantage to that delegated customer? Yes, they have a disadvantage that the delegated customer who underwrites their own files, funds their own files, can do it much faster and with much more control. But they have a ton more overhead. So this is the first trail I'll go down. I didn't intend to go down here, but I'm going to go down here because that's where I want to go. All right, so let's say, for example, now this is a rate sheet that originator would look at. Okay, this is, let me go to a Fannie. Okay, this is not today's rates, by the way. I intentionally did not put today's rates up here. So when a loan officer, and that is whether you're looking at a broker or you're looking at somebody who is non-delegated or somebody who's delegated, they're going to pull up a rate sheet that looks like this. Now, if you're not familiar with it, 100.00 equals par. Okay, so at 2.75 on a 30-day lock, it's par, 100.046. Let's pretend that's 100.000 just for enlightenment purposes. That means that the borrower is not paying to get that rate, a discount, and that borrower is not receiving any credits. Now, you've heard multiple times, no closing cost, it's a sham. If you remember that, that was Lennox Financial that made that really popular back in the early 2000s, I think it was. And they made a killing on it. And they made an impact in the industry because they said closing costs were a sham. And so all that's happening when they do that is this originator comes in here and they say, Mr. and Miss Borrower, I need to know, I want to get a loan, but I don't want to pay you any closing costs. Well, typically lenders have to make between 200 and 300 basis points. What that means is 2 to 3% of the loan amount. So here, right here at 3 1/4, 102.239, that, or the 102.734-ish, that's what this originator would quote the borrower. The borrower comes and says, I would like a loan. I'm not paying any origination fees. I'm not going to do that. Okay, well, no problem. Absolutely. They quote them 3.375. Then the lender, AKA Flagstar Bank, when we purchase that loan, we're going to pay that originator 2.734% of the loan amount for giving us that rate. And I'll be going into that a little bit more as well, how we come up with that. So when we pay that 2.7, or if they want to pay an origination fee of 2.7% up front on the CD as origination fee, we'll give you a 2.75 rate. So what advertisers out there, marketing has done is saying closing costs are a crock. Well, somebody's got to get paid. We all have to get paid. So all we're doing is including it in the rate. If you want a 2 1/4 rate, no problem. You can pay 3.263 in discounts, 2.63% of the loan size to get a 2 1/4 rate. So really, when you're quoting rates to originate to people, to borrowers, it's really, what do you want? In my opinion, when I used to originate, I showed them this grid. I said, you tell me what you want. I don't care. I'm getting 2.5 points to do your loan. How you want to split that up is entirely up to you. And so you give them a little bit of a choice. Now, how is the broker different than the delegated? So this price here, let's say that 275 at 100, that's actually going to be closer to 2.75 is paying 100.5, but a broker's at 100.0. So we're going to pay that delegated. So that would make this, say this 2.5% or this 2.625% an equal par. Say 90, say that this would be your delegated pricing. Oops. And this would be your broker pricing. So is that fair? Yes, it's absolutely fair. Actually, brokers probably have a better rate than many of the delegated customers. And the reason is, when you're a lender, you can build in pricing into the rate. Okay. So what the lender has to do, a big lender like a Movement, all big lenders do this, this is not against Movement, they have to build into their rates a certain amount of money in order to pay your compliance officers, because we're paying them the same regardless, based on this this rate sheet, maybe 0.5 better. So what you're going to find is, depending on how much a lender puts in the rate, is exactly how much is the price on the street. So you'll see a lot of times where a broker's pricing at 102.75 right here at 3 3/8. Well, a large correspondent lender may be closer to 3.75 because they have to make a bunch more money to cover their overhead. So that's kind of an idea of when somebody's quoting origination, you have no idea. It's impossible to know. A broker, though, is going to have the ability not to cushion the rates. Brokers cannot cushion rates. In other words, they can't build in fees. Brokers are required to be exactly what we're offering, they have to take. So they cannot build in anything. I went a little bit longer, I wanted to go on that, but that's important to know, that just because they're a broker doesn't make them bad or the worst rate. Because you have brokers out there charging a very low fee, which makes them very good on the street. Now, the next concept, the thing I want to go over is the difference, and that's just kind of pricing. One of the things I love to talk about, and I want to make sure I get this in, is how does Fannie Mae, Freddie Mac, Ginnie Mae, FHA, VA, and USDA all kind of work. I'm trying to think, I don't have. So, all right, so Fannie Mae, I'm trying to think of the best way to explain this to you guys here. All right, so I'm going to use this screen right here. And again, if you have a question, feel free to put it down here in the questions box. So a borrower comes and applies for a loan, and they come to their loan originator, and that loan originator comes to Flagstar or to some other lender of any capacity. It doesn't matter who it is. And then we close on that loan. What happens when we close on that loan? All right, so we have different options. On your conventional market, you have a Fannie Mae and Freddie Mac. Now, what you do is, although you're selling to the lender, we take all the loans. And so, for example, Flagstar funds about $3 billion a month. That's on average. Other lenders, Wells and Chase, they're in the $20-30 billion mark. So what we do is we take those loans and we pool them together into one, what they call mortgage-backed security. So say Flagstar funds $3 billion in loans, and we have this set amount of loans, and we want to sell the loan. Now, the first important thing to understand is that he who buys that loan and services that loan does not own the loan. Wall Street owns 99% of all loans, except for portfolio products within banks. But Wall Street owns 99% of the loans. And the reason is because we can't keep funding loans because there's not enough money in the banks to keep funding them loans and keeping them. So we package them up and we sell them. So some people are seller servicers, which we are. Flagstar packages these loans into a mortgage-backed security, and we deliver those through an aggregator, which we actually do, I think a lot of ours, or we go to Wall Street. We package those loans and we deliver it to Wall Street, and Wall Street pays us a premium on the coupon rate that we're giving them. I'll explain that in a minute. Or we can go through Fannie Mae and Freddie Mac, and they pool them and then issue them to Wall Street. So there's two options. The larger lenders like Flagstar, we typically go directly to Wall Street because we can get a better price. The smaller lenders, your large local lenders who they say, I'm a direct seller. What that means is they're selling individual loans to Fannie Mae through what they call the cash window. So they sell it, and the good part about that is they don't have to pool them. So Jack Keeler goes and gets a mortgage, they immediately sell it to Fannie Mae. Now they don't get as good a price because they're not doing as much volume, but it is very competitive. And then Fannie Mae instantly gives them the money back. Then Fannie Mae takes all these small local lenders, or even the big lenders sell to them, package all of them, and then they sell it to Wall Street. So lenders on conventional loans can either go around Fannie, Freddie, directly to Wall Street, or they can go through Fannie Mae. Now, and then once it hits Wall Street, okay, whether it's through, now, let me back up for 1 second. All loans that are conventional are a mortgage-backed security. That means Fannie Mae or Freddie Mac guarantee those loans to the investor, okay? So we first, as Flagstar, let's pretend this is Flagstar, we first go to Wall Street and aggregate them into a pool. Fannie Mae then guarantees them, then we sell it to Wall Street as a guaranteed loan by Fannie Mae, Freddie Mac. But the security itself, we're selling direct to Wall Street. All it is a pricing. Don't think too much about it. You can either go directly through them or you can go direct to Wall Street. Just depends on your volume. All of them are backed by Fannie Mae and Freddie Mac, or guaranteed. Then we go to the investors, and the investors pay us for different coupons, which I'll explain in a minute. Pardon me. All right, first off, is there any questions on that? Because that's probably confusing as heck. Makes perfect sense to me, but it may be very, very confusing to you. All right, so I didn't catch that. Didn't it? Okay, so it'll make more sense in a minute, hopefully. All right, so when the loans are sold to Wall Street, we get our money back and then we resell it again. Now, what is Fannie Mae's role in this whole process? And Fannie Mae's role in this is to either buy them, bulk, put them together and sell them to Wall Street, which they do a majority of, or they keep them in-house. But the ultimate purpose of Fannie and Freddie Mac is to guarantee the loan. Now, how do they guarantee the loan? So what'll happen is the servicer, let me go here to the payment strip first real quick. How do they get paid? How does Fannie Mae get paid? How do we get paid? And how does the servicer get paid? So what happens is we split the duties. We sell it to Wall Street and then we pay a servicer. Wall Street basically pays a servicer to service those loans for us. And so Fannie's getting paid to get the G fee, if you've heard that. The servicer's getting their servicing fee, and then we're getting cash from Wall Street so we can go do this again. So how do they get paid? Most people don't know this. Now let's take, for example, a $200,000 loan at a 4.5% rate on a 30-year term at 95 LTV, okay? So the principal and interest payment is $1,013.37. Skip over all the homeowner insurance, that stuff doesn't really matter. It's called payment strips. So what happens is when a borrower submits their payment to the mortgage servicer, again, they do not own your loan. They're just the servicer of it. They already got paid for the loan and they've moved on and regurgitated that income stream or that money to another loan. But the servicing portion isn't. So what happens is on month one, if you were to consider 4.5% rate, the borrower paying a 4.5% rate on a $200,000 loan, the interest collected is going to be a total of $750. Okay. Now, this is going to get confusing, and I apologize. When I'm in person, I have a board. I can really point this out, and people are looking really crazy at me, but I can't see your faces, so my apologies. What happens is that first payment comes into the servicer, and the investor gets their coupon rate of 4%. Then, so out of that $750 in interest, the investor gets their coupon. The Fannie Freddie G fee, this can go anywhere from 0.25 to about 0.56, I think is the average. So I'm just using this as an estimate. Then 0.25 of the interest received goes to Fannie Freddie every single month. And then 0.25, and that's between 0.25 and 0.5, 25 to 50 basis points, goes to the servicer. So on that first payment, out of $750, $666.66 goes to Wall Street. $41.67 goes to Fannie, and $41.67 goes to the servicer for customer service and systems and processes, and employees and stuff like that. Now, why does servicing not want to stick around too long? And the reason, sorry. The reason is as servicing gets, as values go down, as balances go down, look what happens to the G fees, because it's based on interest. The G fee and the servicing fee goes down. So they're servicing the exact same loan, but they're only getting paid $33.46 per loan after month 120. And Fannie's only getting $33.46. That's why servicers don't want anything much over 5 to 6 years in servicing. So that's kind of the payment strip, if you will. Now, when I talk about coupon, the investor coupon, a lot of people don't understand what a coupon is. So what I'm going to do is I'm going to show you a 3% coupon. I think this is it. Now I got to move all this stuff. All right, so when an investor is looking at investing in mortgage-backed securities, and just so you know, this is as of yesterday, and red is bad. So if you want to know what happened to rates, this is what's happened to rates since November, and specifically since January 3rd. It has dropped like a crazy hot biscuit. So rates have gone to pure crud since January 3rd, just FYI. We saw a little reprise, but this is what they're looking at. So this is what I call a 3% coupon. So where did the word coupon come from? All that means it's the rate of return on a investment. That's all it means. So if you're getting 2.5% rate of return, you're getting a 2.5% coupon. That's all that means. It actually derived from, it started out with the Liberty bonds in 1917, which was the first bond. When we were going to war, the government had to raise money to go to war, and no other countries would give us any money, and JP Morgan wouldn't give us any money, and now the typical private investors that's funded all of our previous wars wouldn't give us any money, so we had to do a treasury bond. Those were those cute bonds with the cute girls on them, and that's how they were kind of advertising, you know, invest in your country type deal. Well, what you receive with a coupon, with a bond, is if you gave $100 to the United States government, this is how treasuries work, they're going to pay you back whatever rate of return. So let's say if you give them $100, they'll give you $120 back in 1 year. So what would happen is we would issue a bond, and at the bottom would be a coupon that in 1 year, you would walk up to an actual cash window to a teller and give them the bond, and you would tear off the coupon, they'd initial on it, and they would give you your $120 back, your 20% rate of return. That's not what it was, but that would be your return. So that's where the word coupon came from, if you're ever curious where that came from. So this is how the bond markets trade. When somebody said, what are rates doing today? So one of the things we have to look at is rates change by the second. Now, if this was a live screen right now trading, I would be, by the time I started talking 5 seconds ago, the trading on mortgage-backed securities would have changed. So it's live pricing, and it can change every day. So if anybody asks what's happened to rates or should I lock, it depends on what's happening in the market. So an important thing to understand about markets is this, and I'll explain what we're looking at here. This is just a trading chart, is all it is every single market that we deal with in investments is emotional. Every single trade is emotional. All the everything that happens in a system is emotional. Stocks are emotional. People are emotional. So what they did is, this is what they call technical trading, and these are what we call trading windows. So if you see this purple line right here and this purple line, those are called Fibonacci levels, and these are levels determined that once we hit a certain level, people react. Okay, now these are daily moving averages. This is something else completely, but they're also triggers for what people do. So as you can see, we traded in this window for a very long time. And then right at the beginning of January, the news hit and we went down and we went down and we went down. But as you can see, typically they trade up and down in these windows, same as you've seen in a stock. When a stock comes down to here, what happens? People go, oh, wow, man, that's low. I think I'm going to go buy some of that. Woohoo! And they go out and they buy a bunch of stock. And when they buy stock, guess what happens? The cost of that stock increases because the demand for that stock increases. So then what happens? People start buying and it gets up, or it goes up to here and they go, oh, crud, this is getting too high. I need to sell and make some money off of that. And it goes right back down. Now, this is the bond market, not the stock market, but that's essentially how all trading goes. It also is the Fibonacci levels help because, especially in today's society with stocks specifically, you set buy amounts and you set sell amounts. Well, all stocks have these Fibonacci levels. They have all these tiers. And once you break through what we call the floor, here's your next trading window. Once you break through that floor, it's your next trading window. So it kind of just depends on what's happening. Now, what happened in these was news in the marketplace. So two things happen when you're trading rates or when you're trading stocks. Is it either is emotional, which is technical, preset amounts people are buying and selling at, or it's newsworthy. So as you know, for the last 2 years, there's been news coming out just about every single day. And so the thing I definitely wanted to get to this to understand where that coupon rate came from. That's how we buy and sell. The important thing to understand about stocks and bonds is this, and understand how to impact rates. So stocks and bonds are inverse because stocks are equities. It's ownership in this country. Bonds are debts. So when you're buying a stock, you're saying, I feel good about this country. I want to invest in this country. I feel good about what's happening. And when you want to go to bonds, because stocks are adjustable rates, they fluctuate, obviously, buying and selling. Bonds are a fixed rate securities. So when do you go to bonds? You go to bonds, which are mortgage-backed securities. So the levels are United States Treasury, the most secure, safest, and best investment in the world. And that's not like it's in the world. The second best investment is the United States of America mortgage-backed securities. And it's just a little bit higher because there's a little bit more risk. And then you go up to the corporate bonds, and then you go up to junk bonds, okay? And that's kind of the level. All it is debt. It's equity, ownership versus debt. It's variable, things are good, versus I want security and a fixed rate of return, bonds. Excuse me. So why is that important? It's important because you can tell what's happening to rates just by watching the news. If anything is good for the economy, people go towards stocks. They want to have ownership in the stock. Anything bad happening in the economy, they fly to security. Or if there's something happening in another country, they fly to security. So good for economy is always bad for bonds, always bad for mortgage. Bad for economy, always good for mortgage rates. So that's why we've done so well over the past since 08, once we actually started finding a way to lend money again. But post the big crash, we've done extremely well. Why? Because our economy hasn't done well. So the Fed has had to keep bonds very low, or rates low artificially, which I'll explain in a second, in order to do that. But that's why. So if you're watching the news and they said, hey, jobs report came out, we were expecting 200,000 new jobs. We got 600,000 new jobs. Woohoo! Great for the economy. We are back to work. Guess what? People fly to the stock market. What happens when people there's only a finite amount of money. When people go to the stock market, that means that money's got to come from the bonds. Now, when there's something bad that happens, they get out of the stock market, get out of ownership, and go to the debt, the security, the safe haven of bonds. So whenever you're watching the news, you can almost tell what's going to happen. It's that fickle by the minute, different things. So that's important to understand how and why bonds work. Now, the importance of what does the Fed do? And I know I'm going all over the place, and I'm so sorry for this. This is usually a 2.5 hour seminar. So I'm trying to fit in as much of the cool stuff as I can possibly fit in this short amount of time. But this is kind of the really interesting stuff to look into. Let me find it. Hold on. Boom, 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 boom. Okay. Now we've all heard of that term called quantitative easing. Okay. It's a complicated word people use. It's also known as the Fed is raising rates or the Fed is lowering rates. Well, guess what? The Fed can't do any of that. They can do short term. So when you hear they're raising the Fed funds rate, all that is the rate that banks borrow from one another through the Fed's reserves at the Federal Home Loan Bank system. I'm not even going to think about going there. It's a very cool concept and very cool how the federal home banks work. And then the Fed discount rate, that's what banks borrow from the Federal Home Loan Bank to lend to you. Now that's what they're talking about. When they say Fed's raising rates, right now it's 0.25. A bank can go to the Fed, borrow whatever amount of money that they use collateral for, and the Fed's going to charge 0.25% interest, okay? So by raising rates, what they'll do is they're going to raise it by a quarter, probably 3 times this year. So typical prime rate, and all prime rate is, just in case you're curious, is the rate that banks charge their best customers. That's by definition. It's actually out of San Francisco. It's not even on the East Coast, but it's the rate by which people charge their best customer, which is currently about 3.5%. So as you can tell, the cushion between what a bank has to make and what they borrow at is about 3.25%. That's how much banks have to make when they make you a short-term loan, a credit card, a car loan, a lease, home equity line of credit. Those are short-term loans. Now, when they raise that discount rate to half, well, your rate just went to 3.75. When they raise it to 1, your rate just went to 4.25. Now they're doing this to control inflation. Nah, I'm not even going to get into all that, but because that's very complicated as to why they're doing it and what inflation does. Inflation is bad for bonds, but it's also bad for the economy. But it's called what they call transitory. But anyway, we're not going there. Sorry. So that's when the Fed says they're raising rates. That's what they're doing, short term, not mortgage. Now, how does the Fed lower and raise mortgage rates? Because keep in mind, remember that mortgage-backed security I was talking about that we sell directly to Wall Street? Well, those are investors buying it. So what the Fed does is they say, you've heard the $4.5 trillion in stimuluses they've spent over the last 2 years, okay? Where the heck does $4.5 trillion come from? By golly. And so that's the number one question. Well, they truly do create it out of thin air. So this is what happens. Let's say Congress says we're going to lower rates. So what they do is they type in a little computer, they create money and they buy treasuries with it. Okay. It's not printing money. It's a whole complicated process. It's actually good. It's really cool how it works, but they do an influx into the system by buying their own treasuries or mortgage-backed securities. So since last year, they've been buying $40 billion a year or $40 billion per month of mortgage-backed securities. They've also been buying some other assets, but in order to keep rates low, the Fed becomes a competitor with the investors who are buying our mortgages. Because the Fed is buying $40 billion per month, that is creating a demand for our mortgage-backed securities because there's less available for other investors to purchase. Now, what happens when demand increases? It means we can give them a less rate of return. Okay, so here's an example. Okay, here we're at about, this is a 3% coupon. Remember, 3% is what the rate of return is. We were receiving 4.6%. So on a $100,000 loan, we were getting a premium of $4,600 to sell that loan to them. That was in November. Okay, $4,600. Well, with it, let's just pretend this is the Fed buying. So the Fed buying says, hey, we don't have to give 4.6. We can give, actually, it's going the opposite way. honestly. So this is what happens when this is polar opposite, sorry. So when they do the demand, we don't have to give them a better rate of return. In other words, this would be going polar opposite. Let's go backwards. This is when the feds were not buying and we were paying 2.6 for a 3% coupon, or we were getting 2.6 for a 3% coupon. The Fed starts buying. I'm just pretending this is backwards. This did happen, by the way. The Fed starts buying. Now, because of demand and competition, they got to give us 4.6% rate of return to us, to the lender, for the same coupon. So the more demand there is, the less premium or less yield we have to pay out. Hopefully that makes sense. Now what they're doing is they're tapering. Okay, tapering means that they are now starting to slowly stop buying mortgage-backed securities, creating less demand, or more demand, excuse me, or less demand. So as they begin to taper it down, I think they funded 30 billion in December, and they're hoping to be funding 0 billion and by March, be completely done buying. What that's going to do is it's going to make a whole lot more mortgage-backed securities available, and we're going to have to raise rates in order to give them a higher rate of return because the Fed's no longer buying. That's how the Fed artificially inflates rates, by being a competitor in the market. So why are they raising rates? They're raising rates because of inflation. Inflation is bad for the bond market. Why is inflation bad for the bond market? It's bad because of the dollar cost. So if inflation, let's say if it costs you $100 today to buy a taco, I don't know, it's going to cost you $107 next year. Or what cost us $100 cost us $107 this year. So now it's costing us $107 to buy a taco, which means the value of the dollar has decreased. Well, that's fine in adjustable securities like equities, like stock. But on a fixed rate of return in bonds, that 2.5% coupon is really only worth about 2.4 something, because the value of the dollar is no longer as much as it was when they bought that coupon. So inflation is bad for bonds, but it's also bad for the economy. So what they're doing by raising rates is they're slowing down the economy. So first, they need to slow down the flow of money, which means raising rates, and people start to save more and put more away versus spend more. And then once they can catch up with all of the backlog of deliveries and so forth, you know, the truck, you've heard it in the news, all that kind of stuff. Once we can catch up to that, is what they call a transitory inflation, which they're backing out. So that's a whole nother story. So the important thing here to understand is how bonds and equities or stocks kind of vary. Knowing that that's how the Feds do this quantitative easing, and then how everybody gets paid. So there's 7 questions. So now I better actually reach that. All right. What happens if there's no Fannie or Freddie? 2008. Okay. So what happened in 2008? We didn't have a housing bubble. So what happened is they're called private label securities. So you got Fannie Mae, you got Freddie Mac, and you got Ginnie Mae. Now, just so you know, the difference between Ginnie Mae and Fannie Mae, Freddie Mac is, I don't have time to go into that. But anywho, so those are both guaranteed. They're mortgage-backed securities that are guaranteed by the federal government in one way or the other. So the one thing to understand is in 2008, any Fannie, Freddie, or Ginnie investor in Wall Street got paid. Everybody thinks they went under. No, 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 no. All of those, that's why we did an $800 billion bailout of Fannie and Freddie. They got paid. The investors on Wall Street got paid. Who did not get paid? The private label securities. So we are not going to run into the same situation we had in 2008. We're not having this bubble. It's going to probably go up another 8% this year, anywhere between 2 and 15. But the census is we're going to have about an 8% increase in values this year, is from all the economists. So what was that private label? So the private label is when Flagstar creates a product, you know them as non-QM, and we take those same loans, say we do $3 billion in non-QM, bank statement loans, jumbo loans, anything that's not a Fannie or Freddie or FHA, VA, USDA product. We still fund those loans with our money. We package them in our own MBS, and there's an aggregator on Wall Street that guarantees that, AKA Lehman Brothers. Okay, they're the ones that ate the dust in the 08. So what Lehman Brothers did is they're packaging up 228s. Okay, what happened though is values. So everybody refinanced every 2 years. Millions of people were refinancing every 2 years, redoing the loans because values were going like crazy, like they are now. Then the values stopped, kind of like we're beginning to see a little bit of a slowdown on it. And then all these people owned 100% against their property or against the mortgage. Then what happened is it began to be where they couldn't refinance that mortgage. Well, these ARMs were going from 8% at that time, by the way, 7 to 8% to 15. So as it was it was a pretty quick process. As what began to happen is these houses began to foreclose, which brought down values even more. So the problem was a huge portion of the mortgages in this country were 228s or 327s. They were ARMs that could not refinance because they were all at 100%. And so as the guarantees began to be required by Lehman Brothers, they were having to pay out all these G fees, all these guarantee fees to these investors. But at the same time, nobody was putting any more in the pools. They weren't receiving any guarantee fees anymore. They were paying it out. And really quickly, like, because we didn't have the equity to do it, Lehman Brothers went down, others went down, and that's called a private label security. That's what crashed it. We have very few of those in our country now. That's why the bubble's not going to happen. Anywho, so if there's no Fannie or Freddie, says my connection is unstable. Hopefully you can hear me. That's why we bailed them out. They are private corporations, by the way. Ginnie Mae is not. They are, but they're ran by the United States government since 2008. And how they are backed by Fannie Mae and then sold to Wall Street. So that's all they do is they are, okay. How they're backed by Fannie Mae and then sold to Wall Street. So what happens if a borrower stops paying? If a borrower stops paying their mortgage, the servicer, depending on how they're set up, is required to send the payment to the aggregator, to the MBS issuer, Fannie Mae, Freddie Mac in many cases, and then they bundle those on the 25th of the month, and they send it to Wall Street to get to pay for the interest, their coupon. Okay, what happens if they don't pay? Flagstar Bank has to have reserve requirements for every single loan that we service. We have to pay it. Okay, it's called schedule or actual. Actual means the actual amount of interest received and the actual amount of principal received. The servicer, we have to pay that to the issuer, so it goes to Wall Street. So basically it goes to Wall Street. Schedule is whatever's scheduled to be, even if the borrower doesn't pay, we have to send that anyway. Most of them are schedule. Now that's what also, you want to know why all the banks went down in 08, 300 plus, 400 plus banks went down. They went down because they were having to pay all of these payments that the borrowers stopped paying. Now, when do we get reimbursed? For mortgage insurance companies, we get reimbursed once it's closed. So with Fannie Mae, first level of loss is the servicer or the lender. Then it goes to the MI company, and then it goes to the Fannie Mae to pay. Now they will make us whole at the end, but it's usually at the end of the foreclosure process. So banks have to be able to hold these payments, keep paying to Wall Street, even though our borrowers did not pay, AKA forbearance, 18 months of hundreds of millions of people not paying their mortgage with the CARES Act caused quite the servicing issues, but the government did step in on that. So that's kind of confusing, I'm sure, but how it does. More demand equals lower rates. That is correct. So, he's asking, Marcus got all the questions. Thanks, Marcus. 228s were 2-year fixed. So a 30-year term, what they were doing is they were doing it fixed for 2 years and 28 adjustable. And so after 2 years, they went up. All right, so do we have any other questions? I'm at 10 till right now that you would like explained. And my apologies, I just went over 2.5 hours of stuff piecemealed in about 40 minutes.
Jack, that was a lot. It took me back to my first semester freshman year of college, Econ 101 or whatever it was. So that was really good. I appreciate it. If you mentioned the title Tour de Mortgage, I thought it was based off of the Tour de France, but I had forgotten that I remember you talking about wanting to retire with a bus and a tour group. So now I understand the title.
I really want to do that. I no lie. I've actually looked at purchasing one of the, it came up for sale. What's the ducks, the water duck things? They actually came, I live down in Orange Beach, Alabama, for those of you who don't know, and they were selling the water ducks. I said, I can finally get my own tour.
Actually, a question just popped up with your opinion about with interest rates, with inflation getting high as it is now. Do you see interest rates returning to the teens?
No, absolutely not. That's what they're going to try to control. So with the inflation, and the word transitory means it's artificial inflation, although the Fed is backing off on that a little bit and stating that it's not as transitory as they thought. So because of supply chains, what was happening is everybody's having to raise their rates to pay for employees, to pay for products. And then once COVID goes away, everybody's back to work. They can start producing the same products and services for a much lesser rate, which makes it transitory. It makes it temporary, if you will. And so the 9%, I would say we're probably going to actually have higher rates for this year and possibly next year is what they're thinking. And then probably go into a semi-recession, which is going to lower rates again. So we got to get over the COVID and the inflation hump, then probably artificially lowered again. And the reason is anytime it's called the inverted yield curve. So anytime the 2-year and the 10-year bonds, the treasury bonds, which is what we compete with, is inverted, means that a 2-year bond is bringing a higher rate of return than a 10-year. And what that causes is nobody to invest in the long-term bonds, because why invest in a long-term bond when you get a 2-year bond for much cheaper? And just about every time that's been close as it is right now, 2 years later, we received a form of recession, not the Great Recession like that. It's just a temporary recession. Whenever the recession hits, the economy slows down, and a bad economy is good for bonds, because people, keep in mind, when the economy slows down, they go back to bonds. So what's going to happen is we're raising rates. That's technically bad for the economy because it's going to stop the flow of money. By definition, a recession is when the flow of money in the economy reduces. That's what it is. So what'll happen is we have high inflation, bad for bonds, but we also have an economy slowing down, good for bonds. That's why nobody knows what's going to happen. It's completely clueless. The fact we regained about 30, 40 basis points earlier this week mesmerized everybody. It's like, we don't know why. And so what you have is you have conflicting things happening that are good and bad for the economy. But no, so I would say, nobody knows. Nobody's got that crystal ball. It's probably not going to get horrible this year. Refis are way down. So your business volume will decrease on the refi market. But hopefully next year or the following year, rates will come back down again.
And there was a question, if you can provide, or if you would provide your information in case someone has a follow-up question to ask you offline. Does your material have an email address?
It's here. I'll be glad to answer a question, but I don't. That's part of why it's the Tour de Mortgage Finance, because it's whatever I decide. You saw today. I certainly did not follow a process flow. But I'm always available, jack.keeler@flagstar.com, or if anybody's got groups, I love to do presentations, preferably in person. It's a lot easier for me to follow a process that way, because it's a lot of Q&A is what I deal with.
All right, so after we're done, I'll post in the Q&A box your email address
Okay.
for everyone to see that. But all right, we have a couple more minutes, so just want to give an opportunity if anyone has another question. And I'm just scanning the inbox to see if we missed. And someone asked for a bullet point summary, so maybe if there's a specific question, they can email you afterwards. But yeah, so this it sounds like this is a lot of information. So really
I should have
good.
stuck with 2 slides and just went in deep with 2 slides, but I just like to make sure people kind of know it's not, you sold my mortgage. No, we didn't sell your mortgage. It's been with your mutual fund for about 10 years.
Right. All right, then there was one question here: should we refinance now? And it sounds like your opinion is that rates are going to go up this year. And actually, from that one slide with it was I can't remember what it called it, but things were going bad since early this part of this month. So I think
Right.
that was the one that rates are the time to refi was a few months ago, I guess, but maybe
The best time that you got hit, we were down the high 1s, low 2s. In 2020, 21, they went up a little bit. It was still great rates. We're in the 2s. I would say we're in the 3.5s now. If you want your no closing costs, it's a sham rates, 3 to 3.125. So is it the time to refi? No, I don't think it is. I wouldn't, unless you're doing a cash out. The big thing that your clients are going to get is, if they're marketing properly, is we'll continue to get the purchases. That's a given. People are going to continue to buy regardless. But there's more equity in houses in the history ever, more percentage wise of equity than we've ever seen. So cash out, renovations, home improvements, debt consolidations, awesome opportunity. You can debt consolidate all this stuff and build a thing and go to 3.5%. You may be sitting at 3, but still the dollar cost averaging of not paying interest on some of these other things, you're going to see a huge influx in cash out loans. But rate and terms, if you haven't refied in the last 2.5 years, my goodness.
right.
I mean, wow. So yeah. And, and should you sell? That's another number one question we get. Is, like we said, we're still going to see about an 8% return. You're going to start to see less cash buyers because they're losing their tails, because they're paying way too much money for these houses. Atlanta is notorious for these ridiculous overpricing. So is everywhere else. But 2 to 8% is what you should increase in your value. That should be hitting a bubble at some point, not an explosion, just a bubble that says, okay, it's no longer affordable.
All right. Well, thanks again, Jack. It was very, like I said, very informative. It took me back to my freshman year in college when I realized I wanted to be an attorney and not in money or finance. And everyone, Jack is living the dream working on the beach. So appreciate him. I said I thought he would call in from his deck overlooking the white sands, but thanks again, Jack. And I'll post your email address in the Q&A section in just a few minutes. But yeah, hope to see you soon, and thanks, and have a great day.
Thank you, guys. Appreciate you.
All right, so it is just about the top of the hour, and the second presenter we've got is Kenneth Stroud. And last year, when we were planning for the last year's seminar, Kenny volunteered, or I reached out to him, and he offered to help with a presentation about bankruptcy. And just due to the change in with COVID and the webinar, we had to, in scheduling, it just didn't work out for him in last year, but we were fortunate enough that he was able to keep his presentation. He tweaked it a little bit and is back helping us this year. And, and I don't think I even mentioned Jack's title, but I'll mention for Kenny's title, it's Bankruptcies on Title, Avoiding Pitfalls, and Getting to the Closing Table. And in my practice, I think probate and bankruptcies are probably the two things I don't see very often, but when I do see them, I always need help. So it's good to get more information about bankruptcies. And then a little bio about him. So Kenneth or Kenny Stroud serves as Associate State Counsel for Connecticut Attorney's Title Insurance Company, where he oversees underwriting for Georgia and multiple other states throughout the Southeast region. Kenny received a Bachelor of Business Administration from Kennesaw State University in the disciplines of economics and finance. He spent several years in the insurance and risk analysis fields before enrolling in the University of Georgia School of Law, where he obtained his JD. Prior to joining Caddick, Kenny maintained a successful practice in Metro Atlanta, focused on real estate and real estate litigation, estate planning, bankruptcy, and creditors' rights. He's a member of the State Bar of Georgia, Real Property Law Section, GRECA, and SLTA. So with that, I will turn it over to Tenny. So take it away.
Thank you, Stuart. I appreciate it. It's an honor to be invited to speak at this seminar, and I appreciate the opportunity to do so. I hope everyone can see my screen. I'm going to share my screen now for the presentation. Okay. Stuart, can you confirm what you're seeing? Is it the full slideshow view?
No.
Yes, but I think you can just go ahead and start from the beginning.
Okay. Okay. Now, are you seeing a full slideshow view?
We're seeing the full slide and the next slide.
Okay. Let me swap this real quick. Okay.
Yeah,
That should be. Is that it?
Yes, that's good.
Perfect. Thank you. So, again, welcome to this hour of the seminar. As Stuart mentioned, we're going to be talking about bankruptcies on title and avoiding those pitfalls and trying to get to the closing table. My goal today is to walk you through some commonly encountered scenarios when you see a bankruptcy on title to real estate, and give you some keys and tips on how to get those cleared to get to the closing table. So if this seminar were in person, I would start out by asking for a show of hands for anyone who has seen a real estate title examination with a bankruptcy on title. And generally, virtually every hand in the room is raised. And this is not surprising given that a number of people are forced to file bankruptcy for one reason or another. So what we like to do today is I'm going to walk you through some basic information and give you a background on bankruptcy principles and bankruptcy laws and rules, and then use those to walk through some commonly encountered scenarios. And I did see that someone raised their hand, so I want to check and make sure that this isn't an issue for being able to see anything or hear anything before we keep going. Okay. If you have any issues, post them in the Q&A box as well. I'll try to be monitoring that as we go through the presentation. So, all right. So why is bankruptcy important to real estate practitioners? Well, economic downturns result in millions of bankruptcies. We saw this in the last crash with the mortgage crisis and what's referred to as the Great Recession. And you'll see some statistics on this in a moment. But Georgia in particular ranks fairly highly on that list. So it's common to see a bankruptcy on the title. Now, many homeowners will file bankruptcy trying to keep their properties in a Chapter 13. So you often see real estate titles with a Chapter 13 filing, which is another reason it's important to real estate practitioners. When a bankruptcy is filed and it appears on title, it can present some complex issues and pitfalls for the unwary. And that's why we want to make sure that you're well versed in bankruptcy and how it intersects and interplays with title to real property. And then, of course, it can significantly affect real property transactions and the rights of both the borrower and the mortgage creditor. So just a little bit of background about bankruptcy. So the number of consumer bankruptcy cases filed in the US has steadily increased over the last century. Following October 1st, 2005, there were approximately 12.8 million consumer bankruptcy petitions filed. And just to give you a little bit of background, Congress enacted some major changes to the bankruptcy code in October of 2005. And it's referred to as BAP-CPA, the Bankruptcy Abuse Prevention Act. And so it made some changes, made it a little bit more difficult to file bankruptcy and qualify for a Chapter 7, and implemented the means test and whatnot. So that did contribute a little bit to a surge in people filing in October of 2005. But also economic downturns will inevitably result in an increase in the number of filings. For example, after the last Great Recession, we saw 1.5 million consumer bankruptcies filed in 2010 alone. And the vast majority of those were Chapter 13 cases people filed trying to keep their homes and save them from foreclosure. And some recent trends, we've had improved economic conditions over the last several years, which have reduced the number of bankruptcy filings. But the pandemic has resulted in a slight increase in the number of filings compared to previous years. And just for those of you, obviously, are practitioners in Georgia, as of September of 2021, Georgia ranked 5th in the greatest per capita filings, according to the American Bankruptcy Institute. So just a little bit of statistics to show you how prevalent bankruptcy is. And just on the average, on the whole, I think the trends demonstrate that more people are willing to file bankruptcy in an effort to save their homes or to get a fresh start. So it's not likely that this is that trend is going to shift materially away from that. So a couple of things. Why would someone file bankruptcy? Well, it depends on what their life situation is. But one of the primary reasons of the bankruptcy code is to give the honest but unfortunate debtor a fresh start. And what that means is typically we're talking about a Chapter 7 there. And we'll go into detail about the different chapters here in a moment. But when someone is looking for a fresh start, they're usually looking to leave their debts behind. Some consumers, unfortunately, find themselves having to file bankruptcy due to circumstances outside their control, some life-altering events such as loss of a job, failed business, or just exorbitant medical bills. And then finally, which we've alluded to earlier, Chapter 13 cases are filed generally to try to keep people's homes from being foreclosed on if you're in arrearage on the mortgage. Those are just a few reasons why someone might file bankruptcy. Now, how can bankruptcy affect real property? And this is a high-level view. We're going to dig into this as we go throughout the presentation. First of all, bankruptcy directly impacts whether property of the bankruptcy estate can be sold or refinanced or foreclosed, and if so, who holds the right to sell it or refinance it. Another way that bankruptcy can materially affect real property titles is the bankruptcy code includes a provision that allows a debtor to avoid a pre-petition judgment lien that has attached to the property prior to bankruptcy being filed. And I'm sure you've probably seen this in your practice at some point in time. The last is lien stripping, which is slightly different from lien avoidance. Lien avoidance applies to non-purchase money, non-possessory security interests, basically judgment liens. And you'll see it does not apply to statutory liens as well. Lien stripping is different in that it allows a debtor in a Chapter 13 case to strip off a wholly unsecured second mortgage from title. And we'll talk about that process and what it means to be wholly unsecured later on in the presentation. So there's just a few ways that bankruptcy can affect real property. Here's just a quick overview of what we'll cover. We'll spend a few minutes doing a brief overview of bankruptcy. And then we will turn to the automatic stay, and then we will touch on what to look for when property has been foreclosed during a pending bankruptcy as it relates to title. Then we'll turn to the three topics we just discussed, that is sales in bankruptcy, lien avoidance, and lien stripping. And just to kind of give you a high level overview, this is not meant to be a deep dive into bankruptcy or the practice in bankruptcy court. It is meant to hit the most commonly encountered issues that you'll see on a real estate title. So if there's any questions specifically that are more geared towards bankruptcy, I'll be glad to answer those at the end, or you can feel free to reach out to me. I'll provide my contact information at the end of the presentation, and I'll be glad to talk with you. So part of bankruptcy overview, what are the types of bankruptcies? Bankruptcies are categorized by the chapter of the bankruptcy code under which they're filed. And so the four most common that you're probably used to seeing is Chapter 7, Chapter 11, Chapter 12, and Chapter 13. And I'll go into detail on how each one of these operates in just a moment. But I think understanding the type of bankruptcy that's filed and how the case is handled is critical to understanding how to clear and resolve title defects presented by those bankruptcies. So Chapter 7. So Chapter 7, first of all, is what's commonly referred to as either a liquidation bankruptcy or just a discharge of debts bankruptcy. Chapter 7 can be filed by both individuals and businesses. However, only individuals are eligible to receive a discharge of their debts upon conclusion of the case. A business entity who files 7 will simply liquidate their assets, but with a business entity being an artificial entity and not an individual, they're not eligible to discharge the debts. Now, the primary purpose that somebody might file a Chapter 7 is to discharge all of their dischargeable debts and receive a fresh start. This means that after they file bankruptcy, those debts that are discharged, they are no longer personally liable for those debts. Now, in a Chapter 17, when someone files a petition and schedules, a Chapter 7 trustee is appointed. That Chapter 7 trustee then holds a meeting of creditors. And upon the conclusion of the meeting of creditors, the Chapter 7 trustee then continues to operate as the trustee in charge of the case. Now, what's important in a Chapter 7 is that all assets of the debtor become property of the bankruptcy estate, subject to that trustee's control and disposition. You'll see why that's important in just a moment. The trustee's job in a Chapter 7 is to liquidate non-exempt assets to pay creditors. So for example, if a debtor owns 2 pieces of real property, one which is a primary residence and another that is a rental or investment property, the rental and investment property is generally not exempt. And if there is significant equity in that property over and above any valid pre-petition liens, the trustee will likely move to sell that property and recover money to pay unsecured creditors. We'll talk more about that in just a moment. Finally, I just want to point out that when the debtor receives a discharge under Section 727 at the conclusion of their case, that discharge only relieves the debtor of the personal liability to pay. It does not avoid pre-petition liens. There is a process for doing that within the bankruptcy code, and we'll hit that in just a moment. But that is an important aspect and one that's somewhat confusing amongst practitioners if they're not familiar with the intricacies of bankruptcy. So moving on quickly at a high level, what is a Chapter 13? Well, unlike a Chapter 7, where the primary purpose is to discharge debts and get a fresh start, in a 13, generally the primary purpose is to retain assets and pay as much money to their creditors as they can over time through a plan. Now, the plan is generally between 36 and 60 months. In order to file a Chapter 13, a debtor must have regular monthly income. In a Chapter 13, a debtor may retain most assets so long as the plan and the requirements of the bankruptcy code are satisfied. And again, we're not going to dig into what those requirements are and whether they're eligible and whether the plan is feasible and confirmable. Just know that generally a debtor may retain most assets in a Chapter 13. In a Chapter 13 case, a trustee is still appointed, but the role is different from what it is for the Chapter 7 trustee. A Chapter 13 trustee primarily ensures the plan is proposed in good faith, it meets all of the requirements of the bankruptcy code, and receives and disperses payments under the plan. So generally, a Chapter 13 trustee will not move to sell property of the bankruptcy estate, as that right, as you'll see, is retained by the Chapter 13 debtor in most cases. So the goal of a 13, when somebody files a 13, is generally to try to save their home from foreclosure and try to repay those creditors over time. Now, in a Chapter 13, a debtor may not incur new debt during the plan or sell assets without court approval. So if the debtor is looking to refinance while they're in a Chapter 13 plan, they need court approval. If they want to end up selling their property, they're going to need court approval as well. And then finally, a Chapter 13 debtor is entitled to a discharge in most cases after the plan is completed. And that discharge comes in under Section 1328. Quickly, a Chapter 12, it's similar to a Chapter 13 in the way that it proceeds, but it's only for family farmers or family fishermen. The case proceeds in a similar fashion to a Chapter 13. That is, a petition and schedules are filed, a 341 meeting of creditors is held, and then ultimately the plan that is proposed by the debtor comes up on a confirmation hearing, and the court decides whether the plan is confirmable. That is, whether it meets the requirements and is feasible, and whether there are any objections by creditors. In a Chapter 12, it slightly differs from a Chapter 13 in that it only requires a debtor to have regular annual income due to the seasonal nature of the business. For example, a family farmer may only get paid once a year or maybe twice towards the end of the year after the annual harvest. So the code allows for differences due to the seasonal nature of the business. In Chapter 12, it can be individuals or business entities as long as the business entity is privately owned by the individuals. And we don't see a ton of Chapter 12 cases here in the Metro Atlanta area, but there are a fair number in South Georgia and in North Georgia. Finally, Chapter 11. Chapter 11 is commonly referred to as the business reorganization chapter, but that's a slight misnomer because individuals are eligible to file for Chapter 11s as well. The primary focus in a Chapter 11 is trying to achieve some sort of reorganization. For a business, this can be selling off bad assets, providing a plan to pay creditors over a lengthy period of time. And then also it can be a liquidation. It's not just exclusive to a reorganization. But in a Chapter 11, a trustee is typically not appointed. In Chapter 11 cases, the debtor, who's called the debtor in possession, retains their assets and continues to operate the business in the ordinary course. And in doing that, the debtor in possession is vested with many of the powers and performs many of the functions that a trustee would otherwise perform. The debtor in possession enjoys wide latitude generally. However, they are subject to oversight by the United States Trustee's Office, as well as the court, and creditors and interested parties can move to remove the debtor in possession and appoint a Chapter 11 trustee if they believe that the debtor in possession is not performing their duties in a fiduciary capacity on behalf of the creditors, or that otherwise there's cause to remove them. A Chapter 11 case, ultimately the debtor in possession must file a plan that satisfies the requirements of the bankruptcy code. And then it will go forward through a plan vote, which the different classes of creditors will vote. And if approved, the court can enter an order confirming the Chapter 11 plan, which is binding on the debtor and the creditors as well. So just a high-level view of how those different chapters slightly vary from each other and what the purposes are. And I think that'll help you understand in just a moment when we go through the specifics of the issues on title. Quickly, just a subchapter V. This is a small subchapter of Chapter 11 bankruptcies. It's designed for small businesses as an alternative to the existing small business reorganization. It was recently created, so we haven't seen a ton of experience. I have a ton of experience with how these typically play out and whether they're more advantageous. But the main difference is that when a subchapter V trustee is appointed, their purpose and their goal is to facilitate the speedy proposal and implementation of a consensual plan, consensual being the key word here. They literally act as a broker or a negotiator between the debtor and its creditors to try to achieve a consensual plan to get all the creditors paid quickly. And like a Chapter 11, it's similar to that, and the debtor in possession remains in possession of its own assets with the powers of a trustee, unless the debtor's possession is removed, in which case the subchapter 5 or V trustee will take over. And then finally, a Chapter 20. This is obviously, there's no Chapter 20 in the Bankruptcy Code. So this is when someone files a Chapter 7, receives a discharge, and then files a Chapter 13 subsequently, or vice versa with a 13 first and then a 7, it's called a Chapter 20 because 7 plus 13 is 20. And that's what it's commonly known as. We bring this up because there's some slight reasons where it varies in how it affects title to real property. And you'll see that in just a moment. But there, just so you know, if you're asking the question, why would somebody want to file 2 bankruptcies? Well, there could be strategic reasons for filing 2 cases back to back. One, the debtor, if they file a 7 first, they can discharge a significant amount of their unsecured debt. And then what that does is it frees up that cash flow that they would otherwise be paying to those unsecured creditors by discharging that debt. And they can then devote that income towards curing and maintaining a mortgage through a Chapter 13 plan. Now you'll see curing and maintaining as in quotations because that's sort of a term of art that's used in bankruptcy that we'll talk about in just a moment. But basically it allows the debtor to take whatever arrearage that they have on the mortgage prior to the bankruptcy and put that into the plan and pay that arrearage over time while continuing to pay post-petition mortgage payments as they come due in the ordinary course. So it's referred to as cure and maintain. Now, no discussion of bankruptcy would be complete without referring to the automatic stay. So many of you are probably familiar with the automatic stay, have experienced it before. So the automatic stay is governed by Section 362 of the Bankruptcy Code, and it is a stay that goes into effect immediately upon the filing of a bankruptcy petition and is binding upon all creditors and other parties, even without notice. So what I mean by that is if a creditor takes action in violation of the automatic stay, even without notice, those actions are still void. They're not just merely voidable. They're void from the beginning. For example, a foreclosure sale. If a lender is attempting to foreclose on property, the debtor files a bankruptcy petition the night before or the morning of the foreclosure Tuesday, even if that creditor does not have notice of the foreclosure, or excuse me, of the bankruptcy, any foreclosure sale that's conducted and any action taken after that pursuant to the sale is void because it violates the automatic stay. Similar to filing a judgment FIFA. There's a number of cases coming out of the Northern District of Georgia bankruptcy judges that hold that a judgment FIFA filed after a bankruptcy petition is filed is a violation of the automatic stay and is void as well. So just a couple of examples of actions that would be void even without notice to the creditor of the bankruptcy filing. A creditor must obtain relief from the automatic stay by court order in order to proceed with any actions. That's called, the process for that is filing a motion for relief from the automatic stay and getting an order. And then finally, willful violations can result in pretty severe sanctions. So you just want to make sure that if you're representing any creditors of any debtors, that you're not taking any actions in willful violation of the automatic stay.
Hey, Kenny, there was a quick question about the stay.
Mm-hmm.
Does it take place as soon as the filing is accepted, or is there a delay with that?
No, it goes into effect automatically as soon as the case is filed. Now, if the creditor does not have notice, then I think that weighs in favor of against finding any kind of willful violation. But the stay does automatically arise the moment a petition is filed.
Okay, thank you.
Good question. So foreclosure. Now, so obviously a lot of times debtors, borrowers will file bankruptcy, particularly Chapter 13, to try to stop property from being foreclosed on. Let's say that happens, and let's say the lender then moves to seek relief from the automatic stay to proceed with foreclosure. From your perspective, or from our perspective as real estate practitioners reviewing title, if you run across a title that reveals that property appears to have been foreclosed during a bankruptcy, during a pending bankruptcy, or around the same time as a bankruptcy was filed, there's a few things you want to look out for to make sure that that foreclosure was done properly. The first thing is you're going to want to pull up on Pacer and obtain a copy of the motion for relief from stay that was filed by the foreclosing lender and the corresponding order which granted that motion to lift, modify, or terminate the automatic stay to permit foreclosure. So you're going to want to read the order to make sure its terms were complied with. And what I mean by that is sometimes the orders that are issued will lift the stay to allow the foreclosure to take place, that is the sale, but they require the lender to come back before the court in order to approve the sale before they execute a deed under power of sale to the purchaser. Not always, sometimes it just depends on the facts and circumstances of the case. And so you just want to be sure that everything that was required by the order in order for the lender to foreclose has been complied with. There's also a 14-day appeal period after an order is entered granting relief from the stay that the debtor can appeal. So you'll want to make sure either that the lender waited out that 14-day appeal period with no appeal being filed, or that the order granting relief from the stay specifically waived that 14-day appeal period. I know a lot of creditors' rights attorneys who represent foreclosing lenders will include that request for the waiver of that 14-day appeal period in both their motions and the orders. And I think that's a great practice as it allows them to proceed a little quicker. So that's just when you're reviewing title on property that appears to have been foreclosed out of bankruptcy, you just need to confirm that the lender sought and received stay relief and complied with all of the terms of the order to make sure that that transaction was done correctly. Another thing you might see is orders will provide that if there's any excess proceeds generated by the foreclosure sale, that those would need to be paid over to the trustee as well. I apologize. There we go. Let me just go back here. My computer screen was freezing up there for a second. Okay. Now, property of the estate. So the question is, what becomes property of the bankruptcy estate? That is governed by Section 541 of the Bankruptcy Code. And you just basically, for your purposes, you just need to know that it casts a very broad net. It's basically all legal or equitable interests that the debtor owns in property, with a few minor exceptions. So why does that matter? Why does it matter if something's property of the estate? Well, property of the bankruptcy estate cannot be sold, refinanced, or foreclosed without a court order. And depending on the type of bankruptcy that the debtor filed, the debtor may no longer hold the right to sell the property at all. So in the context of a typical residential real estate transaction, the debtor's interest in real property becomes property of the estate. It's pretty cut and dry. So for example, if a debtor owns property in fee simple title, 100%, all of that interest becomes property of the estate. If the debtor owns property as joint tenants with right of survivorship, the debtor's interest in that property becomes property of the estate. Same with as tenants in common, a life estate, etc. Whatever the debtor owns in that real property becomes property of the bankruptcy estate. There's a few other things, though, that can become property of the bankruptcy estate, even though the debtor doesn't have a vested interest at the time. For example, real property inherited by the debtor within 180 days of filing bankruptcy. In the case of a Chapter 13, property acquired during the pendency of a Chapter 13 case can become property of the bankruptcy estate. And then finally, potentially real property owned indirectly through a legal entity. So what I mean by that is, let's take, for example, an LLC. If real property is titled in an LLC, under Georgia law, the individual who owns the LLC, let's presume that it's 100% of the membership interest is owned by the debtor and he's the sole member. That person does not hold title in their individual name. Therefore, the property technically is not property of the individual debtor's bankruptcy estate. However, because the debtor is the sole member of that LLC, and they do own the 100% of the membership interests in that LLC, the Chapter 7 trustee can take that 100% membership interest and exercise their rights as the sole member, which accrues to the trustee, to either cause the LLC to sell the property and distribute the proceeds to the individual sole member, or dissolve the LLC and distribute the property itself back to the debtor, in which case it does come into the bankruptcy estate. So just a word of caution that even though just because property is titled in an entity rather than the individual debtor's name does not necessarily mean it's completely out of the reach of the bankruptcy jurisdiction. Now that we know that generally all assets, legal and equitable interest of the property, of the debtor in property, become property of the bankruptcy estate, when does property cease being property of the bankruptcy estate? Well, it depends on the type of bankruptcy case. In a Chapter 7, it remains property of the Chapter 7 estate until the trustee either abandons the property or sells it. Now, there's two ways that a Chapter 7 trustee can abandon property. The first is by expressly abandoning it. In that case, the trustee would file a notice of abandonment and serve it on the creditors and interested parties. And if no one objects, then the property is deemed abandoned. And when I say abandoned, it's abandoned back to the debtor at that point. The other possible way of abandonment is called technical abandonment. This is the vast majority of the way property is abandoned. And that's what happens when the trustee goes through the 341. And let's say this is a no asset case. There are no assets or equity in assets that can be liquidated to pay creditors. In that case, the Chapter 7 trustee would file a report of no distribution and then close the case. If that happens, then under Section 554C of the Bankruptcy Code, the property is deemed abandoned back to the debtor when the case is closed after the trustee has filed a report of no distribution. And so in under either scenario, when the trustee abandons property, either expressly or technically, it goes back to the debtor. And why that's important is then the debtor retains that asset because it's been abandoned back to them. They then have the right to sell it at that point. But up until that point, the right to sell property belongs solely to the Chapter 7 trustee. For Chapter 12 and 13 cases, property remains property of the bankruptcy estate until such time as the property is sold, the debtor's case is dismissed either voluntarily or on a motion, or the debtor successfully completes the plan, receives the discharge, and the case is closed, in which case the property revests back in the debtor at that point in time. Similar with a Chapter 11, it remains property of the bankruptcy estate until it is sold or a plan is confirmed, a Chapter 11 plan is confirmed, which revests title in the debtor or possibly a successor entity to the debtor. Now, we touched on this a moment ago, but I want to highlight it again because it's important. What is a discharge and what is it not? Well, a discharge simply relieves the debtor of their personal obligation to pay the debt. It does not extinguish the debt itself, nor does it affect any valid pre-petition liens against the property, unless they're avoided, which we'll talk about in just a moment. So the distinction here is, and there's been some confusion, especially for those who don't practice in bankruptcy a lot, and there's a lot of confusion amongst debtors themselves. They believe that because they've received a discharge of debt, that it wipes out the lien. It does not. Again, valid pre-petition liens will remain liens against the property unless they are avoided. Some liens are avoidable, some are not. We'll get to that in just a moment. And then finally, the debtor's property remains property of the estate until the trustee closes the case without any distribution or expressly abandons the property again. Now, on to that, up until now in the presentation, we've kind of been talking about some foundational principles, high-level principles of bankruptcy. Now we're going to talk about the three most commonly encountered scenarios that you're going to run into in reviewing and clearing title with a bankruptcy on title. And the first of that is sales of real estate in bankruptcy. And the main question we want to ask ourselves first is who can sell the property in bankruptcy and how can they do it? Now, the main takeaway from this is all sales out of bankruptcy require a court order. So that is the touchstone that you're going to want to hang the hat on in dealing with sales out of bankruptcy. So again, property cannot be sold without a court order in bankruptcy. Who has the right to sell depends on the type of bankruptcy case that has been filed. In a Chapter 7, the right to sell, while the Chapter 7 is pending, the right to sell property belongs solely to the Chapter 7 trustee. And what I mean by that is we have seen instances where sellers will put their property under contract to sell either while they're in a Chapter 7 or shortly before they file a Chapter 7 and end up filing, and they lose the right to sell that property. It belongs to the trustee at that point, unless the trustee abandons the property back to the debtor, like we discussed before. In a Chapter 12 and a Chapter 13, the debtor retains the right to sell subject to court approval. And there's a process for that we'll talk about in just a moment. Similarly, at Chapter 11, the debtor in possession retains the right to sell subject to court approval, unless a Chapter 11 trustee is appointed and the debtor in possession is removed for cause. So the most common scenario that you're going to see in sales out of bankruptcy is either a sale by a Chapter 7 trustee or by a Chapter 13 debtor while a Chapter 13 case is pending. So sales in Chapter 7. So recall that in a Chapter 7, all assets of the debtor become property of the estate subject to the trustee's control and disposition. So only the trustee can sell property in a Chapter 7 unless it's abandoned back to the debtor. That's important. Now, the trustee's job, if you think about a Chapter 7, is to liquidate any non-exempt assets to pay creditors. And the trustee will seek to sell the debtor's interest in property if significant recovery for creditors is likely. Now, I'll give you an example of that. Let's say a debtor, Chapter 7 debtor, owns real property that's worth $300,000. There's $150,000 first mortgage on it. If this property is the debtor's primary or principal residence, they can exempt under Georgia law $21,500 if it's a single individual and $43,000 for a married couple. But even taking into account that statutory exemption on top of the mortgage in this scenario, there is significant equity over and above the balance of the first mortgage and the exemption that the debtor can claim that the trustee can sell and liquidate to realize recovery to pay unsecured creditors. So there's an opportunity there, or at least a potential that the trustee would want to sell that property and get that recovery. Now, the trustee, although they have the right to do so, they do have to have court approval to make that sale. And the way that they go about obtaining that approval is that they will file a motion and then serve that motion, notice of that motion on all creditors and interested parties. That is designed to give creditors and interested parties in the bankruptcy an opportunity to review the terms of the transaction, see whether it is in the best interest of the estate or the best interest of their interest as a creditor, and then to potentially object if they do not want a sale to go forward. After that, a hearing may be required if objections are filed. A lot of bankruptcy courts will grant motions for sale based on negative notice if no one files an objection, yet others will require that a hearing be held. And if no one appears or objects at the hearing, then they can grant the motion as well. Just a couple of practice tips, and I know some of you may have been involved in closing a sale when the property is being sold out of a bankruptcy estate. A couple of practice tips are: one, the motion that's filed by the trustee should include detailed information about the terms of the sale. For example, the purchase price, any liens that should be paid at closing, secured creditors or other secured lien claimants. Any costs to be paid out of that, whether it's trustee fees, statutory compensation, agent or broker's compensation, cost of the sale, et cetera. And then ultimately a net sales proceeds dollar figure that will be recovered by the estate. Ultimately, what you need here as a closing attorney is an order from the court approving the trustee's motion to sell. And that order is going to be binding on the trustee and the creditors and allow the trustee to sell it. So a couple of key issues that arise in the context of a Chapter 7 sale. Is the sale subject to or free and clear of liens? Well, it can be both. Section 363 of the Bankruptcy Code governs sales, and it allows a court to order the sale of property free and clear of all liens, claims, and encumbrances if certain requirements are met. Now, I won't go into what those requirements are because I think that is a little outside the scope of our presentation here today. What you need to know as a real estate practitioner is that a trustee can sell property free and clear of any liens. If that is the case, then the liens are divested from the property and they attach to the sales proceeds, which go into the bankruptcy estate, which will eventually be distributed by the Chapter 7 trustee. If the order does not state specifically that it is to be sold free and clear of liens, interests, and encumbrances under Section 363F, then it is presumed to be subject to all liens. That is, the trustee will sell the interest, whatever interest the trustee holds, will be sold subject to the existing mortgage and, let's say, judgment liens, et cetera. So just be careful when you're reviewing the orders, the motions, and the orders that the Chapter 7 trustee files to make sure that whether the sale is free and clear or subject to any liens.
Hey, Kenny, there were, I guess, a couple of questions that seemed on topic to what you were talking about. One is asking, how do you know if there was a bankruptcy since they don't file anything in the real estate records?
Yeah, so that's a good question. And not all examiners will search bankruptcy records. I know some will and some won't. I think that's a conversation that you would need to have with your title search company, is to see if they routinely check bankruptcy dockets to see if the current owners have filed bankruptcy. Sometimes you will see suggestions of stay filed in the real property records, but it's not often. I personally believe that it is a good practice to check PACER in the bankruptcy docket on PACER just to make sure that there's no bankruptcies being filed. I have in private practice prior to becoming an underwriter, I did have my examiner check PACER routinely just to have the bankruptcy docket checked. So that's a good question, but I think it just depends on your preferences and what you can negotiate with your title examiner as to how to check it. Obviously, it's easy. PACER is electronic. You just have to have an account and you can check it within a matter of minutes.
And the second question that you just talked about was asking, what happens if a debtor either changes their mind about filing a petition or just files petition after petition to try to abuse the bankruptcy process?
Well, so changing their mind. Once somebody files a Chapter 7, they can't take it back. Everything has been vested in the authority of the Chapter 7 trustee. Now, a Chapter 7 case can be dismissed by the court if the court finds that it is an abuse of the bankruptcy code under the court's inherent powers. And the creditors and interested parties can ask for the case to be dismissed or for the debtor's discharge to be withheld if there is cause for those items under the bankruptcy code. So just know that on Chapter 7, once it's filed, the debtor can't voluntarily back out of it. A Chapter 13 is a completely different scenario. Someone can file a Chapter 13 and then decide, hey, I don't want to be in bankruptcy anymore, and voluntarily dismiss their case. Now, if they do this routinely, especially to, let's say, stop foreclosure on real property, there are provisions under Section 362 of the Bankruptcy Code that grant relief to mortgage creditors and creditors that allow certain actions to be taken. Like, for example, if there are multiple repeat filings, the code will limit the automatic stay to 30 days from the petition, which can be extended on motion of the debtor, but it would require that a motion be filed and a hearing be held. If there's multiple filings, then you can get, the bankruptcy code provides that the automatic stay does not apply to the real property, in which case the lender can go ahead and foreclose. But it depends on the number of filings, et cetera. And then under 362 of the Bankruptcy Code, you can also get a comfort order from the court. Most judges will grant these, but you can ask for an order to be issued that the automatic stay does not apply to the real property because of the multiple serial filings. And then finally, you can, as a creditor, ask the court to dismiss the case for being filed in bad faith and impose as a sanction a restriction on the debtor's ability to refile for a certain period of time, usually 180 days. So all good questions. All right, so another key issue in a Chapter 7 bankruptcy sale is, let's say the property is jointly owned, but only one of the owners files bankruptcy. Can the trustees sell the non-filing owner's interest too? Yes, they can under Section 363H, but technically it requires an adversary proceeding, which is a lawsuit within the bankruptcy filing. That is, unless the non-filing owner consents to the action that the trustee wants to take in selling the property. Now, the justification for allowing a trustee to sell a non-filing owner's interest is that the property will ultimately sell for more as a whole than it would if just the debtor's half interest or partial interest was being sold. The non-filing owner is not without recourse, though. The trustee must pay the non-filing owner their proportionate share of the proceeds. And oftentimes, the trustee will first reach out and offer the non-filing owner an opportunity to purchase the debtor's interest in the property before marketing it for sale to a third party. So there are some protections there, but just know that a Chapter 7 trustee can sell the entire property even though the debtor only owns a partial interest. They would just need to get approval from the court and get an order entered allowing the sale of the entire property. Now, we talked about sales in Chapter 7. Now we want to switch gears and talk about 13. So in contrast to a Chapter 7, a Chapter 12 or 13 debtor often files bankruptcy to try to keep their home, or in the case of a Chapter 12, family farm. Sales can arise in Chapter 13 in a number of ways. Generally, if someone is filing a Chapter 13 to try to save their property from foreclosure, they're going to propose a plan that cures and maintains the mortgage debt, in which case the debtor cures the arrearage by paying it over time through the plan while paying post-petition mortgage payments as they come due in the ordinary course. And again, the Chapter 12 and 13 trustee's role is to ensure that the debtor's plan is proposed in good faith, satisfies the requirements of the Bankruptcy Code, and confirms that the debtor is complying by making those regular plan payments. Because the Chapter 12 and Chapter 13 debtor remains in possession of the real property, they also retain the right to sell it under Section 1303. So because they retain the right to sell the property subject to court approval, they must file a motion under Section 363 and get a court approval allowing the sale, or they can propose it through a Chapter 13 plan. So for instance, let's say a Chapter 13 debtor knows at the outset of their case that they have a number of creditors they need to pay. They don't have any cash to pay those creditors, but they do have a significant amount of equity in their real property, and they would like to convert that equity into liquid cash to be able to pay those creditors. In that case, the debtor might consider filing a Chapter 13 plan, which already proposes a sale at the outset of the case. If that is done, then the plan itself is what discloses the terms of the sale and the net proceeds that would be distributed to the Chapter 13 trustee to pay creditors. That's one way of doing it. However, that's not very common. The most common way is a Chapter 13 debtor will file bankruptcy to keep their property from being foreclosed on. And then ultimately, at some point in time, they may realize that they're not able to afford that property. And so they seek to sell it to realize a significant amount of equity and pay their creditors. I've seen a number of plans where a Chapter 13 debtor has so much equity, they can pay off all of their unsecured debts and a 100% distribution to creditors, and then still receive a significant amount of cash from that sale to be used towards the purchase of another property or obtaining replacement housing. So that's just a couple of ways that a sale might arise in Chapter 13. By far the most common, I think, is where you see a Chapter 13 debtor filing a motion. So sales in Chapter 13 are subject to existing liens. We'll talk about that when it comes to the closing attorney's role. The order should specify what liens must be paid at closing and what are being paid through the plan. The order should also specify what amount must be paid to the Chapter 12 or Chapter 13 trustee out of the net sales proceeds to fund the plan. And it could be that it's funding the plan in full, or it's only partially funding the plan towards payment of creditors. This is a key point here. As a real estate practitioner, you may be asked by the debtor's bankruptcy counsel to go ahead and provide a draft settlement statement, because that is the best way to put the terms of the sale and show what's going to be realized in the motion, is to attach a draft settlement statement. So you may have been asked to do this in the past, or you may be asked to do it in the future. And I think it's a good idea to try to estimate that as accurately as you can, so that everyone knows what the amounts will be. Now, from a closing attorney's perspective, sales in Chapter 12 and 13 are handled the same way as a traditional closing would be. That is, all the liens are paid off at closing in order to convey clear title. You would pay off any first mortgage, any second mortgage, or any other liens specified in the order that are a secured lien against the property. You would normally prorate as usual between the seller and the buyer. And then the order will contain a specific provision, or should, that the settlement agent must remit a specified amount of the net proceeds over to the Chapter 12 or Chapter 13 trustee as well. So in the context of a sale out of the 12 or 13, as the closing attorney, it's generally business as usual. You will want to obtain a copy of the motion and the order that was granted allowing the sale. And you want to make sure all of those are complied with, all of those provisions are complied with, and that you remit the money over to the trustee after the file is closed. Just a quick note, we don't have a lot of short sales going on right now. We did for a number of years, but if it is a short sale, then the mortgage creditor must consent to the sale. And that would be done primarily by obtaining the debtor's counsel, obtaining the mortgage creditor's consent to the order being entered. Now, quick question. What if terms of the sale change after the order approving the sale? Will you need an amended order? Possibly. So for example, let's say the court has approved a sale at a purchase price of $295,000. And after that, the parties agree to reduce the purchase price to $285,000 due to some needed repairs that were discovered during due diligence. Well, because the amount of the proceeds realized by the estate for the benefit of the creditors is going to be reduced, I believe the debtor's counsel would need to renotice the motion and get a new order. The key issue is whether the amount of money to pay creditors will be reduced. Now, this might be avoided if the order that is presented to the judge for signature contains language that the sale is to occur for, quote unquote, no less than a specified amount. In that case, if it said no less than a purchase price of $285,000, then it would be, I think it would give enough leeway that a new order would not be necessary. Thankfully, though, parties, debtors counsel, creditors counsel in the courts and bankruptcy generally look favorably on motions to sell. And so it's not too difficult to get an amended order. It might delay closing slightly, but just something to think about if you run across that scenario. All right. Another, as we discussed, you can do a sale through a proposed plan rather than a motion. Again, this would be done if the debtor knows for sure that they're wanting to sell the property to fund their plan. In that case, instead of putting all the detail about the terms of the sale in motion, you would put it in the initial plan that's filed. And then ultimately, if the plan is confirmed at the confirmation hearing, that confirmation order would then allow the sale to go through. But again, in either case, as a real estate practitioner, you're just looking for that order from the bankruptcy court that allows the sale at a particular purchase price, and then you can proceed to close it in accordance with, regular practices. All right. In a Chapter 11, the debtor in possession remains in possession of the real property as indicated by the name, and they retain the right to sell it subject to court approval. Generally, in a Chapter 11, a sale can be accomplished by a motion or through a proposed plan as well. Either way, the court is required, a court order is required, except in sales in the ordinary course of business, which I'll briefly touch on. A Chapter 11 debtor can sell real estate piecemeal. That is, if they own multiple properties, they can sell each one by a separate motion, or they can file a plan or a global motion to liquidate all real estate through one motion. Sales can be subject to or free and clear of liens, which we talked about a minute ago. So sales in the ordinary course of business. Those are, for example, let's say a Chapter 11, a home builder or a developer files a Chapter 11 case. They can then allow or seek through a motion to get an order allowing them to continue to sell property in the ordinary course without having to go back before the court for each property to be sold to get a separate order. And so that's because the ordinary course of business for that home builder or developer is the sale of real estate. So there are some flexibilities in a Chapter 11 case that would allow for that kind of thing. Again, sales are accomplished by motion and order or through a confirmed plan. If they choose to do it by motion, they would file it under Section 363 and obtain a court order. The only difference in a Chapter 11 is the court may require an auction or give other third parties an opportunity to bid after the property has been put under contract with a putative buyer. That's designed to generate the most possible recovery for the piece of property. So just keep that in mind if you're dealing with a Chapter 11 case. If it's filed through a plan, it would also include an auction bid process. You would identify a putative buyer, and then that would be put up for an auction bid process as well. Typically, it's in open court, and those who want to bid on it can come in and bid on the property that way. Sometimes it's done outside of court at a designated time and place, maybe the debtor's counsel's office. So if it's done through a plan, what you're looking for is a plan, an order confirming the debtor's Chapter 11 plan, then that confirmation order vests the debtor in possession with authority to sell. So I'm going to skip that because we talked about sales in the ordinary course. Now, lien avoidance. This is big. Another common issue encountered is the avoidance of liens. So there's several types of lien avoidance that's available under the Bankruptcy Code. Pre-petition judicial liens, which we'll talk mostly about, defective or unperfected liens, and then preferential or fraudulent transfers. Now, who can and will avoid the lien depends on the type. If it's a pre-petition judgment lien, the debtor or the trustee can do that. If it's a defective or unperfected lien, it would be the trustee, the debtor, or the debtor in possession, depending on the type of case. And then preferential or fraudulent transfers is generally the trustee's prerogative. So how is a judicial lien avoided? When I say a judicial lien, I'm talking about a judgment FIFA. Someone gets sued, a judgment is entered, and then they ask the clerk of court to issue a writ of fire facias and record it in the general execution docket in the county where the property lies. So judicial liens are the primary target of lien avoidance in bankruptcy. Just a quick note, statutory liens may not be avoided. So mechanics and materials liens can't be avoided under Section 522 of the Bankruptcy Code. Recall that the discharge only eliminates the debtor's personal liability for the debt. It does not wipe out the lien itself. So if a valid pre-petition judgment lien is filed against the real property and perfected prior to the bankruptcy being filed, it will survive bankruptcy discharge unless the lien is avoided by a specific court order. That's where Section 522 comes in. Section 522 of the Bankruptcy Code allows avoidance of judicial liens which impair an exemption that the debtor would otherwise be entitled to. The process for doing that is the debtor can file a motion and demonstrate that the lien impairs an exemption that the debtor is entitled to claim. Now, the code specifies a mathematical formula as to whether or not the judgment lien would impair the exemption. I'm not going to go into a whole lot of detail. That's more of the debtor's counsel's responsibility and role. If you want more information on that, I can provide information on that. There's actually some spreadsheets on the Northern District of Georgia's bankruptcy clerk website that allow you to input various figures and determine the amount or the extent of exemption and the extent of the impairment as well. And I know we're getting close on time here. So here's what the main takeaway on lien avoidance. This scenario often arises when a seller has gone through a Chapter 7 bankruptcy, receives a discharge, and then sells their property. So they mistakenly believe sometimes that just because they received a discharge, that lien goes away. It does not. So what do you need to look for, and what will your underwriter want to see to make sure that that lien has properly avoided. First, you'll want to see the bankruptcy petition and schedules, because we'll want to check Schedule C and make sure that the debtor properly claimed an exemption in the real property. Then we'll want to see a motion to avoid that particular judgment lien and a corresponding order granting that motion and avoiding that lien. And based on the review of those documents, oftentimes we can come to the conclusion that the lien was properly avoided and stripped from title. Again, if the lien has been fully and properly avoided, then it no longer constitutes a lien against the real property. But I would advise you contact your underwriting counsel for approval on each one of those, because there is a possibility that it was only partially avoided. And again, a discharge by itself without a specific motion to avoid the lien and a corresponding order granting it will not wipe out the pre-petition judgment lien. Just the discharge will not take care of it. A quick note on this: a pre-petition judgment lien that did not attach to real property prior to the bankruptcy does not need to be avoided. For example, if a debtor does not own any real property at the time that they file bankruptcy, then hence nothing for the judgment lien to attach to, and then after bankruptcy they acquire real property, that judgment lien will not later attach to this newly acquired real property because of the discharge injunction under Section 524 of the Bankruptcy Code. The discharge in that case wipes out the debtor's personal liability, and therefore a post-petition attempt to attach that FIFA to newly acquired real property would violate the discharge injunction. So just know that if the debtor did not own the property when they filed bankruptcy, then the judgment lien can't attach after they receive their discharge. So I'm going to skip a few of these slides just out of the concern for time here. But this is dealing with unperfected interests and preferential and fraudulent transfers. I'm going to get to the last item here, which is lien stripping. So lien stripping involves the debtor's right to strip a wholly unsecured second mortgage from title. Now they have to prove that it is wholly unsecured. And what we mean by that is that the value of the real property is less than the balance of the first mortgage or any other priority liens ahead of the second mortgage. So in this example, the value of the real property is $100,000, the balance of the first mortgage is $110,000, and the second mortgage is $25,000. Because the balance of the first mortgage exceeds the value of the property, there is no equity for the second mortgage to attach to, and it is deemed wholly unsecured under the Bankruptcy Code. It's important to note that values are determined as of the petition date, and it often requires an evidentiary hearing with true evidence, whether it's an appraisal or some sort of evidence of value as of the petition date. But if the debtor is able to do that, if they're able to prove that the second mortgage is wholly unsecured, they can file a motion. And most likely they will get an order stripping that lien. However, I would strongly caution you, not so fast. Both the orders and the Bankruptcy Code provide that the debtor must complete their plan and receive a discharge in order for the lien to be fully and finally stripped from title. Just getting the order in the first instance is not sufficient. The debtor must complete their plan. We've seen this a number of times where the debtor mistakenly believes that just because they got an order stripping the lien, that it's wholly unsecured and stripping the lien, that's sufficient. And then they end up voluntarily dismissing their case. Well, sorry, you didn't comply with the terms of the order in the Bankruptcy Code, which is you got to complete your plan and receive a discharge in order for the lien to be officially stripped. A good practice tip is have the order stripping the lien along with the certificate of plan completion and the debtor's discharge. You should review that and file it of record in the real property records, because that will help demonstrate to future examiners, future attorneys, the debtor did comply with their requirements and the lien was fully stripped. So just a key thing to know there. Lien stripping really quickly, not available in Chapter 7 cases. There was a brief period in the 11th Circuit which allowed them, but that has since been, as of 2015, the United States Supreme Court ruled that that was not allowable. We do still have a handful of cases here in Georgia. We'll run across title every once in a while where the lien was stripped in a Chapter 7 case. If it was done prior to 2015 and no one appealed that decision, it is still binding as the law of the case. So I would encourage you, if you run across one of those, reach out to your underwriting counsel and get their approval on being able to insure over a stripped second mortgage in a Chapter 7 case. Lien stripping is available in a Chapter 20. So if the debtor files a Chapter 7, receives a discharge, and then files a Chapter 13 case after that, which proposes to strip off the second mortgage as wholly unsecured, that is allowable because they're in a Chapter 13 case at that point. The only difference is it does not require the debtor to receive another discharge. All that is required is that the debtor complete their Chapter 13 plan. The reason for that is once a debtor receives a discharge in the original Chapter 7 case, they're not eligible for a discharge under the Chapter 13, the subsequent Chapter 13. So the courts have said the discharge is not a requirement to the lien being stripped in that limited scenario there. So real quickly, main takeaways before we break. All sales in bankruptcy are subject to court approval and require a court order. So that's the key there. Judicial liens may be avoided, but you want to contact underwriting counsel to confirm before you just insure over them based on an order. Second mortgages can be stripped, but you would want to confirm the plan it was completed and the debtor received a discharge in a Chapter 13. And then finally, your underwriting counsel is here to help you. So if you have any questions at all about bankruptcy and how it affects title, feel free to reach out to your underwriting counsel. We'd love to talk to you. So I want to thank you for being a participant in today's seminar. I hope you've enjoyed it. And if there are any questions and we have time, I'll be glad to answer those.
Great. No, that was really helpful. Thank you, Kenny. It is a little past 12, so anyone who needs to drop off is obviously welcome to do so. There were a couple of interesting questions I thought we would just talk about for anyone who wants to stay on. The first question was, when a property is owned by more than one person, but only one person files a petition, what happens to the interest belonging to the other party, other owners?
Well, that's a good question. And it goes back to what we talked about is whether a Chapter 7 trustee can sell a non-filing, non-bankruptcy filing joint owner's interest. The answer is yes, they can. There are certain requirements that the trustee must show under Section 363H to be able to do that. They have to demonstrate that a sale of the non-filing owner's interest is necessary and is in the best interest of the estate. That's usually pretty easily satisfied if they can show it's going to bring more if they can sell the property as a whole rather than just the debtor's partial interest, which if you think about it from a conceptual standpoint is always the case. I'm not sure that a random third party is going to want to buy a partial interest and be a joint owner with someone they don't know. So I think the justification is a valid one. Now, they are not without recourse. That is, the non-filing owner, joint owner, does get their share of the proceeds from the sale. Whether or not it comes directly from the closing attorney who handles the closing, or whether it goes to the trustee first and then the trustee distributes it, is a matter to be decided by the court in the context of the motion and in negotiations with the trustee. But as I mentioned, if there is a joint ownership of property with only one owner is filed, generally the Chapter 7 trustee will first reach out to the other owner who has not filed bankruptcy and offer and try to negotiate a purchase of the debtor's interest before they market it to a third party, an outside third party for sale. And I would say a lot of times, I mean, I haven't polled any trustees on this, but I would say a lot of times they take advantage of that opportunity and go ahead and buy the debtor's interest so that they don't lose their own ownership interest. Because, one of the aspects of owning real property is it's not necessarily that you want the money, you want the actual property. So you do have rights as a non-filing owner to get involved and potentially save your interest.
So not really getting into, true legal advice, but is that one reason why you think people might, if you have a friend, you want to buy a second home together as a rental property, is it preferred then to maybe create an LLC or a partnership as opposed to having people buy individually?
It can be, yes. Obviously that extra layer of entity ownership gives some protection for a number of reasons, liability protection, but As we mentioned, if there are multiple owners that own an LLC and that LLC holds title, if one of those individual owners files bankruptcy, title to that property does not come in within the bankruptcy estate per se. But the trustee does take over ownership of that person's, that debtor's proportionate ownership of the LLC. And depending on the level of that ownership, they might be able to exercise some rights to dissolve the LLC or distribute the property. If there are multiple owners where the debtor's interest is less than a majority, then it's very unlikely the trustee would be able to cause any kind of dissolution or distribution or sale of the property at that point. So yes, that is a good thing to consider when taking ownership of the property with multiple owners, is through entity ownership.
All right. And then another question was, when a lien is avoided, and my screen is a little fuzzy, so it's my issue with my network, but when a lien is avoided, would a bankruptcy attorney file or get a release or a satisfaction?
Likely not. If a lien is properly avoided and it's fully avoided, that order can be filed in the real property records and cross-referenced to the book and page for the lien itself, and it constitutes a satisfaction or a cancellation of that lien. A lot of times, once a motion to avoid a judgment lien is filed and served upon the creditor, they look at it and they say, okay, there's really not any basis for us objecting to this. They've got the right to avoid this lien. There's nothing we can really do about it. We're just going to close our file, write it off, and we're never going to touch it again. So the likelihood of actually getting a release from someone is very unlikely. Excuse me, very low. So, but I would encourage, just as a matter of documenting the real property records going forward, is if you do have title and you get a copy of the motion and the order avoiding that lien, and you confirm with your underwriting counsel that it's been fully avoided, go ahead and file that a copy of that order in the real property records and cross-reference it to the book and page of the judgment lien in question, because that will help your fellow practitioners and title examiners tie the pieces together going forward.
All right. And then I know we didn't quite get maybe to see the last page of your PowerPoint. Is your email address or phone number on the material that was circulated, or should we just follow up?
Actually, I'm not sure if it is or isn't, but I can go ahead and give my email right now. It is K Stroud. So it's just the first letter of my first name and then my last name, all lowercase, at catic.com, and that's CATIC.com. Feel free to email me there. And then if you want to reach out and have a phone conversation, I'm happy to do that as well. The telephone number is 404-550-7449.
All right. And then I think there's one last question, was more, I guess, of a practice question, is if someone is in Atlanta and able to, I guess, appear in the federal bankruptcy court here, and they also appear in bankruptcy court in another state, in Texas, or do they have to ad hoc admittance, or do you know how that works?
It depends on the rules, the local rules for the bankruptcy court in that jurisdiction. I can tell you, if let's say if someone has resided in Texas for at least the 180 days prior to the filing, then they're entitled to file in that jurisdiction at that point. And so if they reside in Texas, they would need to file there. But whether or not an out-of-state attorney can make an appearance in the Texas bankruptcy as a debtor's counsel would depend on the local rules. Generally speaking, I think a admission pro hac vice is permissible under most jurisdictions' local rules. You may have to associate local counsel, though, as a condition of being admitted pro hac vice.
All right. Well, thank you for staying past the deadline. I know we're about 15 minutes past 12, but yeah, it was very helpful, very informational. And then obviously, Kenny is here in Georgia. But thank you to everyone for dialing in. I won't spend a lot. I know we're late, so I won't spend a lot of time, but we'll say that the next two sessions are February 3rd and February 17th. Lane with the real property section with the state bar. I think there was a bulletin email that had registration information for February 3rd. And then I assume in a couple of weeks, we'll send it out for February 17th. February 3rd, we've got Chad Hunt from the FBI talking about cyber intrusion, best practices. And he actually, I've heard some really good things about his presentation. And then on February 3rd, also, the new ALTA forms, there's a discussion about the changes or edits or updates to the ALTA forms that was passed, I think it was last summer. And then in February 17th, discussion about e-notes and foreclosure e-notes. And we're going to have as a special guest, the General Counsel of MERS, who MERS is a big e-note. I guess they hold e-notes. And then also on the 17th February, Ali Jett talking about quiet title actions, which was a big topic that I guess we saw on the listserv, or people asking about quiet title as a subject for discussion. So thank you to Jack and Kenny and Lane for helping out from the state bar. And that's it. And we'll talk to everyone at a later date. Thanks again.